For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, yeah, it is Managing Your Financial Future. I'm your podcast host, Johnny Dean. I have my good friend and longtime colleague, Professor Rick Plum, certified financial planner professional and accredited wealth management advisor with me. I'm excited about today's topic. I usually get excited about certain topics, and this is one of them, only because I've been the topic is officially entitled 3 Tax Traps You May Have Missed or something like that, 3 tax traps, and which was good because I've kind of developed these over the last month and a half, and we like to keep an eye out and an ear out for things like this that happen, and then we report on them to you through this particular podcast. And then just this morning, I get an email from you, Professor Plum, and you said, well, by golly, I've just found a 4th tax trap, and I'm going to tell you about this.
I didn't just trip into it, but I found somebody who just tripped into it and was just talking to him today.
Yeah. And it's really, it fits perfectly. So when things fall into place like this, I said, well, we got to make sure we talk about this. So this is really going to be 3 tax traps and that most people miss, and 1 bonus. And I'm going to start with that bonus since it's fresh in our minds, and you just mentioned it. Now, these are traps that these are ways that people could lose money, not because of bad investments, but because of hidden tax landmines. And you know, these are common landmines, and these are very easily missed. That's another reason I like this topic, because it's just things that people could, even financially savvy people. So let's start, if we can, because we got to cram all these in the time that we have for this particular episode. Let's start, Rick, with this bonus one, as I'll call it. And the trap is that required minimum distributions have to be taken separately from each type of account. Can you just give this to me in simple terms? Taking extra money from your IRA does not count toward your RMD from your old 401k. That's where we're going with this.
And this one actually has 2 traps in it. But the first one is the fact that I talked to somebody who we help him with a certain amount of his money. We only know about the money. He's been very kind of secretive of the rest of his life. He just said, here, take this. I need an income or the ability to have an income of X amount of dollars from this pool of money. Okay, so we bucketize it. It's a nice number. And we have the ability to take roughly $40,000 a year, a little bit more actually, whenever he needs it. He hasn't needed it in the last couple of years. And so we talked to him about it and say, okay, this is what's going on. And today, earlier this year, like in January, he said, I'm turning 73 this year. What's my required minimum distribution? And so okay, the required minimum distribution from this account is, dollars give or take. He's like, okay. And do you want it now? Because we like to get them done early, just to be done with them. And he goes, no, not yet. It wasn't until about May, June, he called and he said, I need $40,000. So we sent him $40,000. He said he wanted it from his IRA. We sent it to him from his IRA. The allocation of his accounts allowed for that to happen, not a problem. And so and then we did a review, and we called him just the other day and said, hey, what's going on? Here's what's going on. Boom. This is what we're looking at. This is what's going on in your world that we know about. And all that. He goes, oh, by the way, and we asked him, and it's something we do quite often. It's like, what other accounts do you have? And he said, well, I've got this 401k from my old employer that I left a couple of years ago, and I just left it at the 401k. Okay, well, just make sure you take your RMD from that. He goes, oh, well, I called them in January and asked them what my required minimum distribution was, and they said it was $18,000. And that's why I took $40,000 from my IRA. And I said, well, wait a minute. Taking money out of an IRA does not satisfy the required minimum distribution from a 403B, a 401k, a 457, a 401a, any of the other types of retirement plans out there. IRAs are IRAs. And you can mix and match the distributions from your traditional IRAs all you want, but they only satisfy the required minimum distribution from your traditional IRAs. That extra roughly $20,000 you took from your IRA does not satisfy the RMD from your former employer, your 401k that's still at the 401k. It's all there. And so he's like, I got to take another one. I got to pay tax on 20. I don't want to pay tax on $20,000 or 18 and change. I'll call it 20. I don't want to pay tax on $20,000. I go, well, it's been more than 60 days since you took it out of the IRA with us, so I can't put it back in. And you have to take it, or you could postpone it because this is your very first one. You can postpone it until first quarter of next year, but that just means you're going to take an extra $18,000 out next year. And so the problem was he knew that you could mix and match traditional IRA distributions to satisfy the required minimum distribution. He interpolated that and extended it out to the fact that he could do it from any kind of retirement account. And that doesn't work that way. And the other thing that was a problem was when we would ask him, oh, you don't need to worry about my other accounts. They're just, count here or there. I got this thing at Schwab or whatever. But he didn't tell us it was a 401k. So it's kind of my fault for not pressing him harder. I should have said, I've got to know.
Well,
that's my fault.
Well, it is and it isn't. I mean, people do different things with their money. Really what he thought was he found out from the 401k side, which was at another company. It was like 18, 20, call it $20,000.
Yeah, he knew the RMD. He knew the amount.
They said, okay, well, so I know it's 20,000. Let's call it out of the 401k, and I know it's about 20,000 or whatever out of the IRA. So he said, if I take 40,000 out of my IRA, we're done. But you can't do that. The trap is, as we said, that you have to take a required minimum distribution from your IRAs. You can group them, mix and match, as you said. But then you've also got a 401k.
That's that.
And
401k.
maybe another 401k.
Yeah, and unlike an IRA, that let's say I have an IRA that I started 40 years ago, and I have another IRA that I started 30 years ago, and I got one at Schwab, I got one at Fidelity, I got one at XYZ, I got one at ABC, I got all these different IRAs. I started at different times and whatever. It doesn't matter. They're traditional IRAs. I can pick and choose which one I want to take from. I mean, I started one when I worked for X company. I started one when I worked for Y company. They were all over the map. It means I can look at every single IRA and then mix and match where I take the distribution from. Now, if I have a 401k from my employer that I had when I was 30 years old, I left it there, and then I have another 401k from a different employer that I left there, and I've got 3 or 4 former 401ks that from different employers. I can't mix and match the required minimum distribution from those 401ks. Each specific retirement plan has its own specific required minimum distribution. Now, the number is the same number. If they were all in one account, the RMD would be X, and if they were spread out over 20 accounts, because they're different plans, I have to take a distribution. I shouldn't say I. You have to take a distribution from each of those different types of plans. And I don't mean different types of plans being 401k one type. Each of those different 401ks from different employers. And it gets confusing when we get to 403bs. Teachers a lot of times will have 403bs. And they may have worked for XYZ school district and they used a certain 403b provider, and then they went to a different 403b provider for that same school district, and then they switched school districts and they went to a third 401k provider, which may actually be the same provider as with the first school district. So I've got 2 of them with the same place, they're just different school districts. Well, guess what? I can't mix and match all those. The districts are different 403bs. The providers may be the same, but they're not the same. It can get complicated, and that's where knowing what the heck is going on helps save potentially some money.
Well, and that's where having a professional help you do this. So that's the tax trap right there. And many people do have different 401ks. They worked 4 or 5 jobs perhaps over their 40 whatever year career, and it's not uncommon to have different 401ks. So that's just something you got to keep an eye out for. Watch out for those different types of accounts. You probably have a required minimum distribution from
different
each
accounts.
of those. Yes. All right. So that's one. I mean, now the 3 I was going to originally talk about. Let's get on to those here, so that we can get each of them in here on this particular episode. Another one is accidentally paying twice on IRA withdrawals if you've contributed, say, after-tax dollars and you don't report them correctly. So bottom line on this one, and you can explain it, is that if you don't keep track of your after-tax IRA contributions, the IRS will probably assume that all your withdrawals are taxable, even if you've already paid tax on that part of the money, Professor Plum.
Well, the IRS is going to definitely assume that your entire distribution from your IRA is pre-tax money, all taxable. And the 1099 that your IRA custodian is going to send to you and to the IRS for the money you withdrew is going to show that it's all taxable. It's a normal distribution because the IRA custodian has no idea if you ever took and put non-deductible money into your IRA. They have no idea. And the way it works is, when I'm making contributions to an IRA, I have to have earned income to be able to contribute. But then anybody can contribute to an IRA that is working. There's no rules on that. The rules are, can you deduct that contribution?
Mm-hmm.
And sometimes you can, and sometimes you can't. If you make too much money and you are a participant in a retirement plan at work, SEP, simple, any kind of retirement plan at work, then you are limited, if you make too much money, to be able to contribute. Now, the IRA custodian doesn't know what you're doing on your tax return. They just know that you have a job, and they know that you were able to contribute. And so everything to them. And it may be that I have this IRA with custodian A. Maybe I've got my IRA with Schwab, and every time I contributed to that IRA, it was all 100% tax deductible. And then later, I moved over and started doing it with Fidelity, Vanguard, somebody else. But at that time, I was making contributions that were only partially or zero deductible. When I take money out of my IRA, it's not like I can call Schwab where 100% of the deduction was taken, and that distribution from that particular IRA is going to be 100% taxable. Or I can go to the other one, which is mostly after-tax money, and say, well, I'm only taking it from you, and because that's going to be a more tax-efficient use. I can get to my after-tax money earlier. That's not the way it works. All the IRS cares is, what's the total value of your entire IRA? And what's the total value of the after-tax money you've contributed in total to all of your IRAs? Not any specific one. They don't see accounts when it comes to this. When it comes to taxation, they look at values. And then when the money comes out, it's pro rata. If 3% of my if my IRA is $1 million and I've got $30,000 of after-tax money in a smattering of my IRAs, okay, any distribution from any IRA is going to be 3% non-taxable, 97% taxable. And so the problem becomes when people make contributions, and I've run into this over the last 2 years, they don't even know that they're not getting a deduction. They've been contributing, and they just turn everything over to their accountant. I shouldn't say that. I should say tax preparer. And the tax preparer does their taxes and gives it back to them and says, you owe this or you're going to get this refund. And they do it. They never even know that that they weren't deducting it. And so they don't have anything on file that says X amount of dollars is after tax. And then by the time they do start taking money out of the IRA, they have no way to prove it anymore. And so they're going to pay tax twice on that after-tax money. The other people that pay tax twice on it are surviving spouses and heirs. Because if you weren't keeping track of it, you can bet your surviving spouse isn't going to know about it. And you know dang sure your heirs aren't going to know about it, so they're going to pay tax again.
Yeah, even doubly so probably with
you
heirs.
know that's going to happen.
Your spouse might know, but I don't think the heirs
and
would
even
know.
if you have been keeping track of it, unless they know to look for, and this is so, if you have inherited an IRA, and one of the things, and you don't know what's going on, so look at the owner's tax return for the year before they died, or try to get a year when they were taking a distribution, and look for a specific form in their tax return.
Yeah.
And I know you know the form, John, because we've talked about it many times.
We have 8606 as the form.
Yeah, you want to 86 the tax on that stuff. So 8606 is a form, and you want to find out if they filed an 8606 when they're taking distributions, and that means most likely that you've got some after-tax money in there, because if they don't have it, the IRS doesn't know about it, and the IRS is going to tax it.
Yeah, it's a common thing. Some people who don't want to deal with this Form 8606, and they look and they say, well, I have $100,000, say, in this IRA. $99,100 is post-tax. I'm sorry, pre-tax, and 900 is post-tax. Some people just say, the heck with it. I'll just pay tax on it all again.
Well,
it's not
and it
that
depends.
big a
I
deal.
mean, if you get to the point where you've got $1 million in your IRA and there's $1,000 of after-tax money, and you want to have your accountant fill out the 8606, they're going to charge you probably $50 just to fill out the form, and that's more than the taxes you would pay going forward. So it's just not worth it, and that's why
it's not.
You need to be very careful with after-tax contributions. Rolling money from a 401k. Now, it doesn't happen as often, but we've seen this in the past where people somehow end up with after-tax money in their 401ks, and when they roll it, when they terminate employment, they roll it to an IRA, they just say, roll 100% of it over the IRA. Shouldn't do that. If there's after-tax money in it, you can do one of two things with that after-tax money that is much more preferential than rolling it to your IRA. One is just have them cut you a check for the after-tax money. And guess what? It's tax-free. There's no penalty. There's no tax. It's after tax. The penalty, that 10% penalty, is only on the taxable distribution. And if all they're doing is giving you after-tax money, that's no tax. There's no tax and penalty. The other thing, which I think is a better deal, depending on the size, I mean, if it's $50, just take a check. If it's 500, 5,000, whatever, then you can have it sent directly to a Roth IRA. Mm-hmm. And then now you have a Roth IRA that's all after-tax money that's going to grow tax-free, hopefully. And then you've got 100% of the pre-tax money going to the traditional IRA. You don't have to worry about 8606. You don't have to worry about, am I paying tax twice?
Yeah.
Also, the money that's in the account, if you roll over after-tax money into an IRA, well, A, it's part of your required minimum distributions in the future. Even though it's not going to be taxed, it's still part of the IRA. B, any earnings of it are tax deferred. You're going to pay taxes on that. So it's much better to go to a Roth or to your own personal bank account with that money rather than the IRA.
Yeah, in that particular case, it certainly would be. Now, the tax trap in this case is accidentally paying twice, as I said, on IRA withdrawals. It can happen even if you're paying attention. So look out for that. Now, since you mentioned, rolling money in 401ks and all that stuff, I will jump down to the next tax trap, which has to do, it's something similar to that, but it's rolling over company stock the wrong way. Now, that could cost you, thousands more than necessary. Now, this is going to get into something that you're going to call net unrealized appreciation. I want to keep this simple if we can, but rolling your company stock into an IRA could cause you to pay a lot more tax than necessary when you sell that. So talk about that, Rick.
This is a much less common, but can have very wonderful tax impacts, positive impacts if you do it right. If you belong to, it's not small little employers, it's bigger companies. You are an employee of a big company, and either you or they buy company stock in your retirement plan. I've got a 401k. A lot of times the company will match my contribution into the 401k, but they match in the form of company stock, not cash. So I put in $10,000 this year, and they may have put in $5,000 worth of value, but it was in the form of company stock. So now I have company stock in the plan. And it's all deductible. We're not talking about tax deductible, non-deductible stuff here. We're just talking about all pre-tax money. It gets really crazy if we have after-tax money in here too, which I've seen. But it's all pre-tax, but there's company stock in the plan. And then I've been working for the company for a long time, and that company stock has grown in value. I've kept it. Maybe I've even bought some more. And in the retirement plan, that company stock has what we call basis. And that basis is the value of the stock the day it entered the plan. So what was the value the day it entered the plan? My first example, there was $5,000 value. Maybe that stock is now worth $50,000 because I worked for him for 30, 40 years. Or it was AI stock and I worked for him for 30, 40 days.
He's joking, by the
yes.
way, but it could happen, yes.
So what happens is when I terminate employment, there's several rules around this we have to follow, but in basic issues, once I've terminated employment and I'm going to terminate my participation in the plan, meaning I'm going to pull all the money out of the plan. I can direct the company to send the company stock not to my IRA. Typically, when we terminate employment, we roll the account over to an IRA to avoid paying income taxes on it right now. And then we'll pay taxes later when we're retired or whatever the day may be, or our heirs will. With company stock, I can have them send the stock, not a check for the stock, but the stock to an individual personal brokerage account. So now I own the stock personally, not in my IRA. I do have to pay tax on the distribution, but I pay tax on that basis, the value of the stock when it entered the plan, not the value of the stock when it left the plan. In my hypothetical example, I put $5,000 in company stock, or the value of the stock when it entered the plan was $5,000, and now it's worth $50,000. I've just moved $50,000 from my 401k to my personal account, but I will pay taxes on $5,000. That $5,000 is the basis is a taxable distribution. Now I've got $50,000 of stock in my personal account that I can sell in the future and pay capital gains on it. Now, we've talked about it in the past. Right now, we can have $130,000, $140,000 as a married couple and pay no capital gains tax, with that. So there are ways to then sell that stock personally without having to pay the tax on the net unrealized gain. Hey, that's where the name came from. Sometimes it works, sometimes it doesn't. It depends on the tax brackets. This was a generic discussion on NUA, net unrealized appreciation. There are some rules you have to follow, and if you screw it up, then you don't get to do it. So just look for company stock in your plan. Ask for the basis, because they probably won't have it on your statement. And then before you do anything else, call a professional and somebody who actually knows what NUA stands for.
Yeah, they better know. I would hope so. I realize this is a technical part of it, and I don't want to get too technical, but just understand again that if you have company stock in your 401k, if you roll it into an IRA, it could cause you to pay a lot more tax than necessary when you sell it. So there are certain strategies that could help you perhaps pay less or avoid, taxes. You're not going to avoid it altogether, but you could keep your tax bill down. So that's a tax trap that people do need to know about. Now, this last one here, as we're running out of time, but I do want to cover this here, is that a Roth conversion could spike your Medicare premiums if you don't understand what are called the IRMA brackets, IRMAA. So in simple terms here, a big Roth conversion might not just raise your taxes, it could also cause your Medicare premiums to jump, in some cases, hundreds of dollars a month, right?
It could, yes. I mean, that's a problem. Any spike, capital gain sale, any Roth conversion, anything that pushes your income up over certain thresholds can create an additional wonderful premium for Medicare, for your Medicare Part B, C, or D. And it gets, it can get up there quick. And now when you get that increase in premium, you obviously get better care from Medicare. Wait a minute. No, that didn't happen. That's not going to happen. But it basically gives you the privilege of paying more, you rich people. So for 2025, if your 2023 income was, as a single person, was over 106, you get the privilege of paying more, anywhere from $75 to $450 more per month for your premiums. If you're married filing a joint return and you're over $212,000, then you start going up on your Medicare premium. It's called IRMA, Income Related Monthly Adjustment Amount. It's based on your income from 2 years ago. So we're waiting for the new announcement for what the 2026 IRMA level is, based on the 2024 tax return that we can't do anything about.
Yeah, it's too late to do that. And this, as you said, it's not. I said Roth conversion, but really anything. You could have a big home. You could have a home sale. Where
anything one-time movement or multi-year movement in your income going over those thresholds.
Now, is it generally for most people in general a short-term thing, like maybe a 1-year thing, when they maybe did a big Roth conversion or they had more income than they expected, does this IRMA thing?
Well, it rears its ugly head in a lot of ways. I'm hoping that your advisor, if you have one, helps you understand what you were doing with a Roth conversion before you did the conversion and knew that it was going to happen. If you're doing it on your own, you may find out accidentally. Where I've seen IRMA hit people unexpectedly the most is the sale of a property. a vacation house or something. As they're getting older, they're like, oh, we're not using this anymore. So we sold this. And because it's not a primary residence, you don't get the exclusion of capital gains. And they've had it for a long time. So they've got a couple $100,000 capital gain. Then 2 years later, the gift that keeps on giving, they get a notice from the Social Security Administration, IRS, that says, oh, instead of paying $185 a month for your premium in 2025, you get to pay as much as $628.90 a month, per person, because of that sale you had 2 years ago that you forgot about. Yeah, well, we didn't forget about it.
Well, it takes them that long to get the returns processed,
Correct.
so they won't know about it. Even if you somehow plan for it, you won't actually get that bill for 2 years. So and
the whole idea is that the Medicare premium that you're paying, which currently in 2025 for most people is $185 a month, that number is actually 25% of the actuarially derived premium for Medicare. The government covers 75% of Medicare Part B. We pay 25% of Medicare Part B premium. That's what that insurance should cost. As you go over the thresholds, they feel that you're rich and you deserve to pay a higher percentage. They're going to subsidize you less. So instead of 25%, the first threshold becomes you pay 35%, then you pay 50%, 65, 80, and as much as 85%. Common number for the IRS. 85% of your Medicare premium is borne by you, and only 15% is subsidized by the government.
Well, gee, so if they're only paying 25%, where's that other 75% coming from, Rick?
It's coming from general revenue.
I don't think so. It's coming from thin air.
Oh yeah.
Anyway, that's a whole other discussion. But yeah, it's, for most people's everyday purposes, this is something you need to look out for. I have a feeling that things like this income related monthly adjustment amount, IRMAA, IRMAA, probably of the things we've talked about happens maybe close to the most. Just because, as you said, people do when they retire, they maybe sell a vacation home, or you could sell a primary residence that you got, much bigger gain in than the 500,000 exclusion. You've seen that, I'm sure.
I've seen that. And you asked is it usually one time? No, I'll bet half the people I see in IRMAA are systemically in it, and they're always going to be in it unless they do really big Roth conversions. And it's a question of, do I jump my tax bracket a little bit for 1 year? Or do I let the premium on my Medicare go up for 30 years, or however many years I live? And it's just one of those. It's a tough question. I mean,
well, it jumps up, but for many people, it can jump back down if it was just a one-off.
Yeah, if it's a one-time event that spikes your income over the threshold, then it's a 1 year worth of premiums, because they're always looking 2 years prior. Like I said, the 2025 is based on the 2023 return. If you sold that property in 2023, if you did that Roth conversion in 2023, and then you pay the premium in 2025, but in 2024 you didn't have a spike, and your adjusted gross income in 2024 was under the 200 and some thousand for a married couple, your premium will come back down to whatever the normal premium is. And the normal premium is going to be about $210 for 2026. I think.
Is that right?
I heard the announcement. Yeah, it's supposed to go up about 12%.
185 to 200. Really? Huh. Okay. Seems to me that
maybe about 205. Maybe I think I calculated it out. By the time this airs, we will have probably gotten the announcement. So I'm probably
okay.
I know the Social Security increase for 2026 was 2.8%.
Yeah, not bad. Not too bad. I mean,
yeah, but the Medicare premium is going up by 12, so you're not going to see all 2.8% in the bank every month.
Well, unless there's those of you who are taking your Social Security at 62 and you're not paying the premium quite yet.
Correct.
So,
yes.
Yeah, that's the nice thing. Well, this has been a fun discussion. I told you before I was looking forward to this, and your email to me this morning really put this over the top, because it is we're talking about these things that happen in general, but the first tax trap that we mentioned, which was that you have to take RMDs separately from each type of account. That was a real world example that just happened within the last week with a client that you were talking to. So it's good to talk about this stuff, and it does happen more often than you expect. And one of the reasons we did want to talk about this was because it is easy to miss. Every single one of these is easy to miss.
Unfortunately, yes.
Yeah. I mean, that's why I think I may have called them landmines, and that's metaphorically speaking, I think that's probably a very good term. If you want to know about this stuff, all this really relates to what Rick said earlier, which was that you got to have an advisor who understands this and knows what to look for and knows the right questions to ask. Do you have, a 401k at some other, money management company that we don't know about? That's fine. I just need to understand where your, things like your required minimum distributions. It's important to understand that. So the advisor needs to know what question to ask. Talk to the people at Lucia Capital Group, because they, along with Professor Rick Plum, who heads the Department of Financial Planning, know which questions to ask. 800-644-1150, the number at Lucia Capital Group, 800-644-1150. Talk to them about things like this. You don't want to get trapped. Very important. Also go online. You can learn more about this stuff. LuciaCap.com, LuciaCap.com. You can download one of our many guides, or all of our many guides that we have on these things. Taxes, things like Social Security. If you want to know about all that stuff, go there to LuciaCap.com, type that into the search bar, and you can download these free guides, which I think are very, very helpful. Just a PDF, quick read, and easy to do. Don't forget to subscribe to this podcast. I got to remember to tell you this earlier than that. You go to Apple Podcasts, Spotify. Most of you have done that already. A few of you have not, so please continue to do that. Subscribe and listen to every single episode. I think you're going to get a lot out of it. I get a lot out of it every single week. My thanks to you, Professor Rick Plum. This has been a joy as always.
Thank you.
All right. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I am your podcast host, Johnny Dean. Thanks so much for listening. Managing your financial future. We will talk to everybody, including you, next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. 1, leave the money in their former employer's plan if permitted. 2, roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3, roll over to an IRA. Or 4, cash out the account value. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. An asset allocation strategy does not ensure a profit or protect against loss. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Stock investing includes risks, including fluctuating prices and loss of principal. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial.